The Q3 and Q4 roller coaster. Buckle up, investors. Get ready, because the markets are about to get interesting. Third and fourth quarters are historically wild cards. They can be a time of great opportunity or gut-wrenching dips. We've seen it time and time again. These last two quarters are crucial for your portfolio. Major holidays drive consumer spending, impacting earnings, and the granddaddy of them all, Christmas. Plus, we're heading into an election year. Be prepared. Now let's talk about elections. They have a funny way of messing with everyone's heads, especially investors. Uncertainty breeds volatility, and election years are full of it. Will taxes go up or down? What about regulations? These are questions that keep investors up at night. Historically, the stock market tends to be a bit more volatile in the months leading up to a presidential election. But here's the interesting part. The actual impact of who wins on the market is often short-lived. The markets are forward-looking, meaning they react to expectations more than actual results. Cryptocurrencies, on the other hand, are a whole different ballgame. They're still relatively new to the game and haven't been through as many election cycles. This makes them even more unpredictable. Regulation is a major concern for crypto investors. Different administrations have vastly different stances on digital assets. The bottom line is this: election years can be a wild ride for both stocks and crypto. But remember, volatility can create opportunity. Just make sure you're prepared for a bumpy ride. So, where do things stand right now? Well, the S&P 500, a key indicator of the overall stock market health, has been on a bit of a roller coaster this year. We've seen some impressive gains, but also some pullbacks. The crypto market, as always, has been even more volatile. Bitcoin, the biggest name in the game, has seen its fair share of ups and downs. We've had regulatory crackdowns, adoption by major institutions, and everything in between. It's been a wild ride, to say the least, but here's the thing. Despite all the volatility, there are reasons to be optimistic. The economy is still strong, interest rates are rising, which can be good for certain sectors, and innovation in both the tech and crypto spaces continues at a breakneck pace. The key takeaway here is that while there are always risks, there are also opportunities. It's all about understanding the current landscape and making informed decisions. Section 4 Q3, Volatility Brace for Impact. Let's talk about Q3. Historically, this quarter can be a nail-biter for investors. Several factors come into play. Summer vacations lead to thinner trading volumes and increased volatility. Earnings season can cause market swings. Geopolitical events also play a role. Q3 often brings a perfect storm of factors that amplify market movements. Section 5 Q4, time to buy the dip? Now let's talk about Q4. Historically, this quarter has been a good one for investors. In fact, it's often referred to as the Santa Claus rally period. There are a few reasons for this phenomenon. First, investors are often in a more optimistic mood during the holiday season. They're feeling generous, and that sentiment can spill over into the markets. Second, fund managers are often looking to boost their returns before the year ends. This can lead to increased buying activity, especially in stocks that have performed well throughout the year. And let's not forget about tax loss harvesting. Investors often sell losing positions in October and November to offset capital gains. This selling pressure can create buying opportunities for savvy investors. Of course, there are no guarantees in the market, but historically speaking, Q4 has been a good time to be invested. If you're looking to buy the dip, this might be your chance. Section 6. Playing it safe, smart strategies for uncertain times. So, how do you navigate these potentially turbulent waters? Well, first and foremost, don't panic. Volatility is a natural part of the market cycle. Instead of fearing it, learn to embrace it. One of the best ways to manage risk is to diversify your portfolio. Don't put all your eggs in one basket. Consider investing in a mix of stocks, bonds, and even alternative assets like cryptocurrencies. Another smart strategy is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market price. This approach helps you average out your purchase price over time and reduces the impact of market volatility. And if you're really feeling unsure, there's nothing wrong with sticking to more conservative investments like index funds and ETFs. These funds track specific market indices, providing broad market exposure with lower risk than individual stocks. Remember, investing is a marathon, not a sprint. Stay disciplined, stay informed, and don't be afraid to seek professional advice if you need it.